Hi everyone, we are now going to look at Chapter 5, which we are going to switch gears. Chapters 1 through 4 of every first accounting book is focused on illustrating all the steps in the accounting cycle. So it is imperative that we understand that in order to continue through accounting. We need to know how to make journal entries. We need to understand that every journal entry must be posted to the general ledger accounts that were affected. We need to know we have to make trial balances to make sure the balances in our account are equal, which the trial balance leads to the financial statements, which is really the whole purpose we are here. And then we need to know that at the end of each accounting year, we have to reset the temporary accounts to a zero balance so that the general ledger is ready to start accumulating information in them for the next accounting year. But we focused on the accounting cycle for a service company because really that's the easiest company to start with. Now we're going to talk about a merchandising company. Now you need to understand that the merchandising company is going through all the steps in the accounting cycle. We're not going to do all the steps for a merchandising company because that would just be redundant from what we've already learned. So we're going to show you the unique things that happen in a merchandising company that didn't happen in a service company, and the resulting types of journal entries at the different phases of the accounting cycle. So that's really small print, I know, but these are all of our conceptual, analytical, and procedural items that we're going to complete. First, we're going to describe what a merchandise activity is and the income components. And then we're going to identify and explain inventory asset and the cash flows of a merchandising company. So we need that overview. What's a merchandiser anyway? We're not doing anything with the analytical side because we don't do anything with ratios in our first semester. But the procedural side is where we will focus the bulk of our attention. Specifically, Procedure 1, which is analyze and record transaction when a merchandising company is purchasing. Procedure 2, what happens when they sell? What kind of journal entries result? P3, what kind of adjusting journal entries does a merchandiser have that a service company didn't? And what extra or accounts are involved in closing the accounting year? And then the final procedure we're going to look at is we're going to modify now our income statement. Back in Chapter 4, we showed you the classified balance sheet. Now we're going to show you a different type of income statement that most merchandisers make, and that's a multiple step. So let's look at this importance of periodic reporting and the role of accrual accounting when it comes to merchandising. So in our service organization, we sell time to earn revenue. So it's either physical work we're doing or mental work, but it's time essentially we're selling. So the revenue, okay, is what we charge our customers, and then the expenses are the items we have to pay for to run our business. And the profit is our result from providing our time, selling that time. A merchandiser is a little different. A merchandiser is a company that sells products to earn revenue. And we're going to focus on companies who purchase products that are already made and sell them to their customers. That's how they make money. They pay for them at one price, which is called cost, and then they sell them for another price, which is higher, called the selling price. Examples: sporting goods, clothing, auto parts stores. Now, if you're sitting there going, yeah, but what stores do I know, right? Walmart. Walmart is a huge merchandiser. They don't make any of their stuff. And if you say great value is not Walmart. Walmart is Walmart. Great Value is a company owned by Walmart, but Great Value is the one who makes that product. Okay, so Walmart buys the products off Procter & Gamble, your toilet paper, your paper towels, your Pampers, your shampoos. Procter & Gamble is a manufacturer who makes these products. We're not going to talk about those type of companies in this course. There's a whole separate course called Cost Accounting and even Managerial Accounting that deals with manufacturers. We're going to focus on the Walmart, who buys the product from Procter & Gamble and then sells to the public. So this type of company makes revenue from selling their product. But they had to buy something, so they had a cost or an expense in order to make revenue. They cannot make revenue unless they buy a product. When they sell a product, the cost of the product they sold, you'll see in a few minutes, is recorded in an account, an expense account called Cost of Goods Sold. I remember when I was learning this going, why does it have to be so long? But look what it says. It's the cost of the goods that have been sold. So here's what we charged our customers, net sales. Here's how much those things cost us that we sold to those customers. The difference is our profit, and we call that gross profit. From there, we then subtract our other expenses related to running our business. And that's ultimately how we get to net income. So it's more of a stepped process to get to net income than we did with a service company. Because we first need to see, well, how much profit did we even make? What's our net revenue, if you want to look at it that way, from even selling this product? Because we had to buy it to sell it. The next objective we need to look at is explaining the inventory asset and the cost flows of a merchandising company. Well, let's see what that means. So, that's a great picture. It looks busy, but it really is great. It starts with A. The company needs to get cash. So the very first place it gets cash from is the owner. In order for a merchandiser to be successful, they have to purchase items. And these purchases are stored in an asset account called merchandise inventory. Just like when we bought supplies, you own those supplies, call them an asset. It's the same thinking. When we buy inventory, though, these are assets we buy to sell to our customers. That's our business. That's how we make money. So we purchase inventory stored in this inventory account. Then we sell. Now we could sell for cash and immediately convert our inventory into cash, or we could sell on account or for credit. Then it's stored in an accounts receivable, just like when we did service on credit. And then ultimately the sale is collected and it's converted back to cash. Companies, merchandisers like this are constantly doing that cycle. The only way they can make money is to sell their product. That's the only way they can get cash. And the only way they can sell is to buy product. So they're constantly in that cycle. Now, when it comes to inventory, we start with beginning. So you see over there on the left, it says beginning inventory. So what was the cost of the inventory, the items we bought and have on our shelves at the beginning of the accounting year? Then we're going to buy stuff during the year. We add that to the beginning inventory. And those two together equal something called merchandise available for sale. So that's the cost of everything we could have sold, every single inventory item in our store. That's how much it cost us. There's only two legal things that could happen to that merchandise during the year. It's either sold or it's still on the shelf. If it's still on the shelf, it hasn't been sold yet, The value of the items still, the cost of the items, I shouldn't say value, I should say cost. The cost of the items still on our shelves are stored in our inventory account as ending inventory. Everything that has been sold, the cost of those items is moved into an account called cost of goods sold, that expense account we just talked about. So that's a great graph to refer to when you're like, you're stuck in, what's going on here? That is what a company does. They start with the beginning cost of the inventory. They add their purchases for the period. They say, here's everything we could have sold. Part of it is still here. That's ending inventory, and the other part has been sold. Now, sorry about that. I needed to step away, so if you had a pause there. But there are two different types of inventory systems in accounting. One is called the perpetual system, and the other is called the periodic. Good news, you're only learning one of them. Your book shows both of them. But only one is really used anymore in the world. When I was in college 30 years ago, I learned the periodic system. The periodic and perpetual system, all they do is tell us when to record journal entries with regards to inventory. That's it. And the periodic system was big back when I was young because there was no such thing as scanners at cash registers. The clerk had to manually input the selling price of the item, and the selling price was on the product. Imagine that. I remember sitting in the student center at LCC when I was a student there, and someone came in and said, there's a talking cash register at the supermarket. It talks. And we were amazed. So 30 years ago, we didn't have the kind of technology we have today. So we had a different kind of inventory system. And basically it says this: whenever we buy inventory, we record that we purchased inventory in the inventory account. Whenever we sell inventory, all we do is record the sales revenue related to the sale of that product. Don't change the inventory account. And really, we can't, because back then, when you got your cash register receipt, it just had numbers on it. It didn't say what was sold or how many were sold or anything on it. It was just like a tape from a desktop calculator. So the company didn't know what specific items they sold. So they couldn't decrease inventory when they actually sold stuff. What they would do is wait till the very end of the year and count the inventory that was left. And it was kind of like, remember our I can't go backwards, but that illustration, beginning inventory plus purchases, here's everything we could have sold. Well, if we know what's left, then the difference is what we actually sold. And we made one big journal entry at the end of the year to remove all the inventory that we sold. We would credit the inventory account for the cost of everything that was considered to be sold. That wasn't very accurate. And then when we started getting these great barcode systems and the technology is cheap and companies, even small businesses, are now scanning, it's a no-brainer. Companies should use the perpetual system. And the perpetual system says this: you make a journal entry for inventory every time it changes when it changes. So you'll increase inventory when you buy more, and when you sell it, you have to decrease the inventory account because you know what you sold now. 30 years ago, they didn't, unless somebody was standing at the end of the cash register writing it all down. They didn't do that. That was inefficient. They didn't need to. But the perpetual system allows us to be more accurate. And now with computers, guys, we're not doing these journal entries physically at work. The computers are doing them as soon as the sale is made. So the journal entries you're about to see, especially when we're selling products, we use point of sale terminals now at all major companies. They're recording journal entries directly into the accounting system when the sale is made. Artificial intelligence, right? Okay, so let's take a look. So we're going to start looking at the perpetual system. That's what you're going to learn. So we're going to look at the typical types of transactions that occur and how we record them when a company purchases inventory. So now they're getting their inventory in stock to sell it. So we're going to do this with examples. So one way a company can buy inventory is for cash. So on November 2nd, Z-Mart purchased $500 of merchandise inventory. Who knows what it is? It could be potato chips, okay, to put in their mini mart. It sounds like a Z-Mart or, like Walmart. It could be anything, toilet paper, anything. But the point is, a Z-Mart, their cost to buy this was $500, and they bought it for cash. So you debit the asset, merchandise inventory, increase that, credit the asset cash. It's like when you buy any other asset. Whenever you buy an asset or buy inventory with cash, it's paid for. It's done. But take a look at this next one. Now Z-Mart's going to purchase 500 of merchandise inventory on account or on credit. There's credit terms. We haven't seen these before. Credit terms are 2, 10, and 30. Whoa. Well, the day we buy the inventory, we're going to debit merchandise inventory for its cost, $500, and we're going to credit the liability accounts payable. Those credit terms don't mean anything to us right now. The day of the purchase, we just debit the inventory, credit accounts payable for the cost. What do they mean though? The first number is always a discount percentage. The second number is always the number of days the discount is available from the purchase date. Comma, N stands for net or all. It doesn't mean subtract the discount. It means otherwise pay all of it by the last number in 30 days. So customer or company, in our case, because we're purchasing the inventory, company buying the inventory, if you pay us in the first 10 days from the day you bought this, subtract 2% off of what you owe us. Otherwise, pay us by the full amount by the 30th day from the purchase. Okay, so when you see those numbers, that's what they represent. They're not always going to be 2/10 N/30. So, a deduction from the invoice price is granted to induce the company to pay early. Absolutely. If there was no discount offered, when would this creditor receive their money? On the 30th day. But when you give a company an incentive to pay you early by offering them a discount, chances are you'll get your money sooner. And this is it's not as common as it once was, but it's out there and it happens. Oy, 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 right? Look at that thing. Here's an invoice. So this is what Z-Mart would get. Okay, showing them what they bought. So we have the seller was Trex, it looks like. The invoice date, so the day that the purchase occurs. The purchaser is us, Z-Mart. The order date is number 4, which is the PO date, purchase order date, 10/30 of 2018. Here's your terms. Credit terms 2/10 N/30. We'll talk about number 6, freight terms, FOB destination, and how it's being shipped. It looks like FedEx is sending it. And then there's the items. So they're listed, the quantity that was sent, the price for each, and then it's totaled up. Now directly on this invoice, it looks like they tell them, hey, if you pay according to the credit terms, you're only going to have to pay us $490. And calculate it. 2% of $500 is $10. $10 minus 500, if they pay in the first 10 days, they'll only have to pay $490. So, On November 12th, the 10th day, Z-Mart paid. Remember, to Z-Mart, this is an accounts payable. They owe this. How much do they owe? $500. So they have to debit accounts payable for the full $500 on November 12th when they pay for it. They're only going to pay $490 in cash, and there's that computation again. What they do here is they take a shortcut. What you can do is take 500 times 2%, which is $10, subtract the $10 from 500. What they're doing in this slide is saying 100% is 500. You don't have to pay 2%. So your cash amount is only 98% of $500. So it's just a shortcut to get to the 490. You get the same result. So where does this purchase discount go? It decreases the merchandise asset inventory account. And if you're sitting there saying, well, we didn't return anything, no, but we paid less for the inventory than we originally thought. 3 slides ago, we debited inventory $500. Did we pay $500? No, we only paid $490. So now we have to decrease the inventory account when we take the discount to reflect we didn't pay that $500. So we decrease it on the credit side when you take a purchase discount. So there are the T accounts. So you can see these, remember, journal entries get posted. So on November 12th, the company would have debited accounts payable. There's the credit to merchandise inventory. Now it truly reflects what they paid for it. And then credit to cash. Now, if you were in high school and took accounting, you probably learned the periodic system. So if you're saying, why aren't there purchase discount accounts? They're not going to be. That's the other system, and we're not learning the other system. So if there's anybody out there a little confused, nope. Anytime we take a discount on the amount we have to pay for a purchase, it gets credited to the inventory account, the discount amount. Now, what if we decide, oh, we're going to pay this December 2nd? Well, we just didn't take the discount. We owe the full amount. Debit accounts payable for the $500, credit cash for $500. Just like any other time you pay a bill. So we now have purchases with returns and allowances. Sometimes we might receive stuff from our supplier like Procter & Gamble. It might be damaged. Okay, so we may have to return it. That's known as a purchase return. So the merchandiser has the right to return stuff to their supplier. Merchandise returned by the purchaser to the supplier is called purchase return. Another thing that could occur is that instead of returning the merchandise, the company, us, the one buying it, says, oh, we'll keep it, but we don't want to pay full price for it. And if our supplier agrees, they're going to say, okay, we'll reduce the price by $15, whatever. That's called a purchase allowance. So in a purchase allowance, the company still keeps the merchandise. They just don't owe as much on it as they originally did. So a price reduction to the buyer of defective or unacceptable merchandise. So let's see how these work. On November 5th, Z-Mart, the buyer, so that's us, we're doing the journal entries for Z-Mart, issues a $30 debit memorandum for an allowance from Trex, and that's what they call them, debit memorandums, for defective merchandise. So key in on that word, allowance. So what Trex did was said, well, I should say Z-Mart called Trex and said, you sent us defective merchandise. Trex says, what do you want to do? Well, we can keep it, but we want you to reduce our bill by $30. Trex says, okay, I'll issue you a debit memorandum, meaning we're reducing the amount you owe us by $30. What happens over at Z-Mart? They debit accounts payable because they owe $30 less, and they credit inventory because now they're paying $30 less for that inventory. Because when they originally bought it, remember, they debited for the full cost, the inventory account, and credited accounts payable for the full cost. Well, no, now they're getting $30 off. They do the same type of journal entry when it comes to purchase returns. But they're really kicking this up a notch here. Let's take a look at this. Z-Mart purchases $250 of merchandise on June 1 with terms $210, net $30. Now remember, that means 2% discount if you pay in the first 10 days. No discount, you pay the full amount by the 60th day. So there's the June 1st journal entry. Debit merchandise inventory, credit accounts payable, $250. June 3rd, Z-Mart decides to actually return $50 of the goods they just purchased. When they return them, they'll debit accounts payable for the full $50 and credit merchandise inventory. They don't own that anymore, they sent it back. So what does this mean to Z-Mart when they're about to pay that bill? Now take a look here. Up in the top, we credited accounts payable for $250. We originally owed that much. But when we returned this stuff on June 3rd, we reduced our amount we owed by $50. So we only owe $200. So if they pay in the discount period, which they are on June 11th, they'll take the 2% discount on the net of what they owe, the $200. So debit accounts payable for $200. 2% of $200 is $4. So we'll reduce how much we owe by $4. Credit cash then for $196. And remember, purchase discounts are credited to the inventory account. Credit the asset merchandise inventory for the same reasons we talked about a few slides ago. Now, the final type of journal entry we usually see when we're purchasing has to do with transportation. You know, goods just don't fly out. Well, they don't fly out of the sky yet, right? Even then we're going to be charged with the drones delivering stuff. But for the most part, they don't fly out of the sky. So how do they get there? Well, they're either coming on a train, a boat, a truck, an airplane, but there's some mode of transportation getting the goods from the seller to the buyer, okay, from the shipping point to the destination. Now, and the shipping point is when it leaves the seller. There's your truck delivering the goods. I don't really know if a dump truck would do that, but okay, that works. And then the destination is the buyer. Now there's two major types of ways to ship. FOB shipping point, which is free on board. FOB, that's what that stands for, shipping point. What that means is it tells us who owns the goods while they're in transit. We know who owns them back at the sellers if they haven't been sold yet. The seller has. We know who owns them when they're at the buyer's store, the buyer. But who owns them while they're on the truck or the airplane or the boat or the train? These terms define that. So FOB shipping point means ownership of the goods transfers to the buyer when they're shipped. So while they're being shipped, the buyer actually owns those. Okay? The buyer, since they own them, are responsible for any transportation costs. So when they pay for the transportation of the goods from where they're from whoever they bought them from to their place, they debit merchandise inventory for the cost of the freight, the cost of the transportation cost. They don't have a special account called shipping costs or anything like that. That's a different system. So anytime the company is responsible for paying shipping, to get its inventory to its place. So it's being shipped, FOB shipping point. They debit inventory and credit cash when they pay that transportation bill. If it's FOB destination, the seller is responsible for the cost of the transportation. Why? Because ownership remains with the seller until it reaches its destination. So the buyer doesn't take ownership until it reaches its store. So on the mode of transportation, the seller is responsible. When a seller pays for transportation, that's an expense to them. It's a cost of doing sales. So they will increase a delivery expense account and credit cash over at the seller. We're not too worried about the seller right now. We're more concerned with the buyer. So the only time the buyer will not pay for transportation costs is if they're shipped FOB destination. So in this case, Z-Mart, when they purchased these goods, they negotiated with Trex and determined that they would buy them FOB shipping point. And that's all a negotiation, how they're shipped. As a buyer, I always want them to be FOB destination. As a seller, I always want them to be FOB shipping point. So you always got to negotiate. In this case, Z-Mart said, that's okay. We'll pay for the shipping. We'll ship them FOB shipping point. And the transportation charge is $75. When they're paying that on November 24th, debit merchandise inventory. Remember, you debit the inventory for the cost of getting the inventory to your location, credit cash. Okay, so those are the major journal entries that are associated with a merchandiser purchasing their inventory. How much they originally are charged for it. Any discounts that they take are subtracted. Any returns or allowances they receive are subtracted from the original cost. And any transportation they're responsible for paying because they're buying their inventory is added. So in our inventory account, in this example, the balance in the inventory account would be $232,400 because all of these journal entries would have involved your merchandise inventory account. So that's the purchasing side. Now we're going to look at typical journal entries when the company sells the goods to the customer. So now we're on the other side. So this is what we're focused on. What are the net sales? How much were the sales of the merchandise? We'll talk about the rest of that in a little bit, but we're focused on that $314,700 right now. How do we get that? Well, each sales transaction in a perpetual inventory system involves two parts. The first is you must record the revenue received, okay, on the sale. That's how you make revenue. So how much did you charge the customer? Okay, you're definitely crediting a revenue for the selling price. Now, what you debit depends. Did the customer pay you immediately? If they did, you'll debit cash. If they didn't, you'll debit accounts receivable. But that's all for the selling price. The other thing you have to remember is we just sold an asset. Remember, inventory is an asset. We just sold it. So we have to, in a perpetual inventory system, immediately decrease the inventory account for the amount we originally paid for that, the cost of it. Remember I said in the very beginning, there will be a cost of your inventory and a selling price. We debit an expense account called cost of goods sold. It's the only expense account you'll see without the word expense. But what's in it? Well, first let's back up. When the company purchases inventory, they own it. But when they sell it, it transforms from being an asset into being a cost of sales. You had to buy that inventory in order to make that revenue. So we take the cost of the inventory out of the inventory account by crediting it and debiting an expense, because this is a cost to the business. Now I know I said that and I'm thinking maybe they'll picture this, okay? Maybe you can. If you can't, we're about to see it. Just wanted to give you an overview. Take a look. Z-Mart sold $1,000 of merchandise on credit, on account. The merchandise originally cost Z-Mart $300. Two types of journal entries. Here's your first. You're going to, since this is on credit, debit accounts receivable for $1,000 because the customer owes the money. Credit sales. That's what companies typically call their revenue account in a merchandising. It'll either be sales or sales revenue. So we've recorded the revenue side of this sale. What's the other side? Now we've got to decrease the merchandise inventory account by crediting for what it originally cost the company and debit the expense account, cost of goods sold. So you'll always have two journal entries when you sell, inventory in a perpetual inventory system. Now, some companies will offer their customers sales discounts. So now it's going to be Z-Mart we're thinking about. If Z-Mart offers their customer a discount for paying early, what happens? Let's take a look. Z-Mart completes a $1,000 credit sale. So now they're selling on credit with terms 210 net 45. So now Z-Mart is saying to their customer, they're on the other side of it because now they're selling. They're saying, if you pay in the first 10 days, customer, you will receive a 2% discount. Otherwise, pay the full amount within 45 days. Now, the assumption in this transaction is that the original cost of the merchandise to Z-Mart was $300. Let's see how this journal entry will differ. November 12th, instead of debiting cash, we would debit accounts receivable, $1,000, credit sales. I think we did debit accounts receivable before. Well, either way, now there's a discount being offered to our customer. Before, it was us taking a discount when we bought our merchandise and paid it early. Now our customer is going to take a discount if they pay it early. A little different. We also will have to debit cost of goods sold and credit merchandise inventory. Now, what happens if the customer pays within the discount period? So we tell them, customer, pay us within 10 days, take 2% off what you owe us. Well, now this customer is taking a sales discount. And that's how we record it. A sales discount account is a contra sales revenue account. So we don't debit sales or sales revenue because most companies want to keep track of how much did we give in sales discounts. And if they did debit sales or sales revenue when they gave the discount, or when the discount was taken advantage of, it would be lost in the sales account. Instead, the company says, no, through the year, let's debit sales discounts to a contra revenue account every time we have one. Then at the end of the year, we could see how much in total sales discounts we're taking advantage of. So that's why we do it. Remember, a contra account always has an account it's linked to. In this case, it would be sales. And it increases on the opposite side of its linked account. So sales increases on the credit side, sales discounts will increase on the debit side. How much cash is the company ultimately receiving from this customer? $980. And that's okay, we're fine with that. We got our money within the first 10 days. What if the customer instead decided, I'm going to pay after the discount period? Okay. Then they're going to send us all $1,000. Debit cash for $1,000, credit accounts receivable. So we'll only have this sales discount account involved when our customer takes advantage of paying their bill early. Just like we could return goods that were defective or ask for an allowance, so could our customers. So when the customer is returning goods, they're called sales returns. And if a customer asks for a reduction in selling price, they're called sales allowances. So it usually involves dissatisfied customers and the possibility of future sales. So sometimes, we got to kind of lean into our customers there and let them kind of have the upper hand on us, I guess, just so that they remain faithful to our company. It's all about good faith. So sales returns refer to merchandise that customers actually return. Sales allowances refers to the company reducing the selling price due to defective or incorrect merchandise being sent to them. So let's take a look. This is important. When a customer returns merchandise which was sold for $15, it originally cost us $9. Okay. If the goods are not defective, well, I should say either way, whether they're defective or not, here's what we do. We debit sales, returns, and allowances, another contra sales account. So we have two contra accounts keeping track of information about sales. One keeps track of the discounts taken on sales. This one is going to keep track of the total amount of sales, returns, and allowances. And we'll credit cash because we would have to give the customer cash. Now, if the goods are not defective that are sent back to us, we'll put them back on our shelf, right? We're not going to throw them away. So we're going to debit inventory. Hey, when we thought we sold that, we credited inventory, but it's back. So we have to put it back into our asset account inventory and take it out of the expense account, cost of goods sold. So debit inventory, credit cost of goods sold. That isn't sold anymore. It was returned. But what if the goods are defective? Okay. So in this case, it looks like the goods might have a value of $2. I don't have the example in front of me, but it should be in your book. So basically it's saying they were defective and really they lost value of $7 because of being defective. We still credit cost of goods sold for the original amount we debited it for, $9. But instead of putting the full $9 back into merchandise inventory, we only put the $2, that the value of it now. And the rest is the loss from defective merchandise. And a loss is an account that's treated just like an expense. Okay, so it will be debited when it increases, and a loss account appears on our income statement. Okay, so if you see expense or loss, they're treated the same way. They increase on the debit side, and they both go on our income statement. We usually use something called a loss if it is something that we lose, that we lost value in, I guess you can say, or we sold and didn't sell it for enough money. Instead of calling it an expense and just crashing everything into an expense account, we kind of pull those items out and call them losses. But they're really a cost of doing business. So they are subtracted on the income statement. And you'll see losses more as we go through the semester. What if the buyer just calls, our customer calls and says, you sent us this defective stuff, but instead of us sending it back, we think we could probably sell it. We paid $40, like you guys charged us $40 originally. How about you take $10 off of that. And Z-Mart says, yeah, great. Sounds good to me. Z-Mart is not receiving any of their merchandise back. Okay, the customer is keeping it. All they'll do is debit sales, returns, and allowances for $10 and credit cash because they got to give the customer $10 cash. And this is kept track of in that contra account, sales, returns, and allowances, which will ultimately decrease our sales. And you'll see that in a little bit. Okay, so those are our journal entries when we sell stuff. Pretty straightforward there. Lots of practice you guys have to do because we looked at them separately. We said, here's the typical journal entries when we purchase. We could purchase with cash. We could purchase on credit with or without discount terms, and we saw the journal entries related to that. We could have purchase returns or purchase allowances, and we may have to pay for transportation costs. And we saw the typical journal entries. Then we looked at the selling side, how we have to record each sale. First, the revenue related to the sale, and then the removal of the inventory, 2 journal entries. What happens if a customer sends stuff back, a sales return? What if a customer that we offered credit terms pays their bill early and takes a sales discount? So really focus on learning those and getting confident in them, because in your problems, they're going to be mixed up. Because companies just don't buy everything and then just sell everything and then buy it. They're constantly buying and selling. Okay, so these transactions aren't happening isolated. All right, so in P3, we're going to prepare adjustments and close accounts for merchandising companies. So what kind of special adjusting journal entries does a merchandiser have? Remember chapter 3? Okay, so this is our, okay, this is too much. We're just going to fly right over that. Here we go. This is what we want. Companies at the end of each year, no matter what type of accounting system they use, perpetual or periodic, will always count their inventory. There's no way of getting out of that. So if you're like, wait, my company does a physical inventory account. I thought they kept track of all the purchases and sales throughout the year. Yeah, they do. But things happen. You know, things get borrowed permanently. Okay, stolen, or they break and nobody wrote it down. Okay, so a company will still count and see how much inventory do we have, and they'll compare it to what's in the account, and the difference, you need to make an adjustment. So in this case, it looks like there was $250 less of inventory than was on the shelves. We call that shrinkage. That's just what they call it. So we don't go, oh, well, we have $250 less on the shelf than we do in our account. That's good. No. What's on our shelf must be reflected in our merchandise inventory account. So we have to decrease the merchandise inventory. And even though it's not sold technically, that's what we assume. So we'll debit cost of goods sold. The key here is that we must expense that part of our inventory. It's not here anymore. It was stolen. It was broken. It was misplaced. The real world, that's how it is. It's not perfect. So that's an adjusting entry a company will do. Another adjusting entry the company does, and this just came out in the last couple of years, the FASB, those Financial Accounting Standard Boards people, changed our rules with regard to revenue. And it's the new revenue recognition rules require the reporting of our sales at net amount expected. And this is getting really technical. And here's essentially what it says. If you have any customers that in the future you think will take their discounts and haven't yet at the end of the year, estimate how much those future discounts may be and record them this year. Because the sales happen this year. Since the sales happen this year, any discounts that will probably be taken because they paid their bill early next year, they should be reported this year. Crazy, huh? But that's what we have to do. It gets really technical. Why? Because they want to truly reflect the sales revenue that actually is going to happen. If somebody takes a discount next year on the sales from this year, our sales were too high this year. Another thing we have to do now is estimate how much in returns we're going to have on this year's sales that haven't occurred yet. So how do we know that, right? Well, we usually try to look at our industry and say, well, what's the normal for people to return? Or we'll look at our own past history. How much of our sales usually come back? And then we'll determine an amount based on that kind of analysis. The key here is that any returns that we expect to happen that haven't happened yet must be recorded in the year of the sale. And that's what that's talking about. So we're not going to do any more with it. We're just going to make you aware of it. If you are an accounting major, oh, we're going to have fun with that, right? We're going to show you how we do all of that. But for now, you just need to know that there are special adjusting entries because of this new revenue recognition principle. Okay. How about those closing journal entries? Well, closing journal entries are closing journal entries, but we have some new accounts we never had before. Remember, a closing journal entry resets temporary accounts to 0. Now our revenue account is called sales. So our sales account will be debited for the full amount because it's credit right now, and then we'll credit that income summary account. Still use the income summary. Take a look at these items in red. We have a brand new expense account called cost of goods sold. That has a debit balance in it. Well, you got to reset that to 0. That needs to be 0. It's an expense account. And those two contra revenue accounts, they both have debit balances. They also have to be reset to 0. Sales discounts, sales returns and allowances. So those are just some of the new accounts. And BTW, remember that loss we saw? That would also be reset to 0 in journal entry number 2. It would be credited just like all the expenses. We would still close our balance of our income summary to capital and then close our withdrawals to capital as we had in the past. We just want to show you there's some extra accounts here that weren't here in Chapter 4 due to the type of company. Remember, we're exposing those items that are different for a merchandiser. Okay, finally, our final area, our income statement. And it's usually a merchandiser who prepares what we call a multiple step income statement. And it's multiple step because it lists some information and then does a calculation and gives us key intermediate numbers that are very important for decision makers. So if you're doing this and you're going, I like the other one better. So do I, the single step, the one we've been doing. But the multiple step gives our decision makers more information. So that's why we do it. Let's see it. Whoa, that's small. This should be in your book, Exhibit 5.13. This is a multiple step income statement because you complete it in multiple steps. The very first step, the very first calculation, I even go before gross profit, it says there. Your very first calculation is calculating sales, the net sales. Take a look. Sales, and this is from the trial balance in your book, and this example we've been looking at through this whole PowerPoint presentation. Sales are $321,000. That is all the sales we had. Nothing is subtracted out of that. That was the gross amount of sales we made. During the year, if we had any sales discounts taken or sales returns or allowances given to our customers, we kept track of those in those contra revenue or contra sales accounts. So now let's subtract the debit balances of those. Remember what I said? We kept track of them in that separate area. If a decision maker wants to know, how many discounts did you have? There they are. How much in returns did you have in allowances? There they are. Now subtract them. How much in sales did we really have? The difference, $314,700. Okay. So that's our first calculation. Then we subtract the major expense of a merchandiser. Let me say that one more time. We then subtract the major expense of a merchandiser, which is cost of goods sold. And now we know what's in there. It's the cost of the inventory that we sold to make this sales revenue. So we charged our customers $314,700. The stuff we sold cost us $230,400. So how much profit did we make? $84,300. Gross profit, we call that. And that's our second major calculation. Very important calculation for decision makers. If that's negative, you're in the wrong business. That means you're giving your stuff away. You're not charging your customers enough. Then the next major section of our income statement is what we call operating expenses. And these are expenses directly related to running our business day in and day out, the operations. We further break these down between those directly related to selling our product and those indirectly related to selling our product. So selling expenses are those directly related to our product sales. So take a look here. Depreciation expense on the store equipment. Yeah, definitely. That's where we sell our product, is in the store. Total sales salaries expense for the salespeople. Rent expense for the selling space. I'm sorry, my eyes are, I'm not seeing this stuff all the way. Store supplies, advertising. Okay, so we group all of those expenses that are directly related to selling our product first and put a total out for them. So then decision makers can say, oh, selling expenses for this time period were $42,100. The indirect expenses are called general and administrative. So these are the office people that are necessary to run the business day in and day out, but are not directly selling the product. And expenses associated with their area. Depreciation expense on the office equipment, office salaries. Insurance is in here. Rent of the office space, office supplies expense. Okay, so we group those together. Now, I'm not expecting you to know all of these and what is related to what, okay? But I'm just telling you how we do it in practice. We group them all together. We total them. In your homework in that, you'll be told what's what. What's a selling expense, what's a general and administrative expense. But those are our two major groups of operating expenses. We then add those together to get total operating expenses and then subtract the total operating expenses from gross profit. And that result is called income from operations, our third major calculation. Income from operations is one of the most important numbers on your income statement because that is how much money you made from your core business, doing whatever you do at Z-Mart. Sometimes a company will have other revenues, what we call gains, expenses, and losses. Gains and losses are from the result of once in a while transactions. Here's the kind of things that could result in a gain or a loss. We saw the loss because we had because of the inventory, defective inventory. You could see here, the company sold a building. They're not in the business of selling a building, but they sold it and they made some money. So that gain is reported like a revenue. It increases net income. It's not called a revenue, but it's stored in a gain on sale of building account on the credit side, and we know it increases net income. Interest income. This company isn't in the business of investing. No, they're a Z-Mart. But maybe they have some investments that earn interest income. That's income to them. So we don't report the income in their direct operations above in their operating operations. No. we report it as an other item afterwards. It's still going to add or subtract from net income, but we don't include it to get income from operations. We would skew that number if we did. Take a look at the final item, interest expense. Interest expense is considered a cost of financing the business. It's not a cost of operating your business. You took a loan out. Now you're financing your business. So any interest expense that a company pays is categorized as an other item. And you notice there's brackets around it. And that's because we are reporting income here and expenses. So revenues and gains, expenses and losses. So if there are any expenses or losses, you must put brackets around them. You're going to net those items together, and those are your total other revenues, gains, expenses, and losses. So in this case, there's an overall $2,000 gain or revenue. Add that to your income from operations, and you ultimately get to what our final number always is on the income statement, net income. So now you're completing an income statement in multiple steps, as compared to a single step, what we've been doing in chapters 1 through 4. Chapters 1 through 4, you add up all your income no matter what it's from, all your revenues. See, there's the gain on sale of building, interest, revenue, sales. Add up all your expenses and losses, subtract them from your revenue, and you get your net income. It doesn't tell us as much as a multiple step. That's why most merchandising companies use multiple step. Okay, and we've talked about the classified balance sheet already in chapter 4, but take a look where merchandise inventory asset ends up in there, right after accounts receivables. Okay, so I challenge you, go out to a public company's website. Maybe I'll do a little video on it just to show you these companies use classified balance sheets and multiple step income statements. So I'll do that. It'll be in a separate recording, and you could take a look and relate it. This is what I'm learning. Wow, Starbucks really does do that. Okay, and that's probably the company I'll use. So please post any kind of questions you may have on the discussion board related to this chapter. I'll also be recording, I think it's for 2 problems in chapter 5, a voice lecture reviewing the B problems. So watch for that as well. Okay, thanks.